Hey everyone, welcome back to MarketSnap. STLA is on a lot of watch lists right now. Before you pull the trigger, we're plugging it into MarketSnap's fair value calculator. Growth priced in? Margin of safety? Let's see. We are talking about Stellantis today. This is the company behind Jeep, Ram, Chrysler, Dodge, Peugeot, and Fiat. It's a massive global auto conglomerate that has been through one of the wildest rides in recent stock market history. The stock is down something like 75% over the last 5 years, and it has fallen hard from its 2024 peak. But here's the thing, the narrative is starting to shift. We've seen some big headlines about a turnaround, a return to profitability, and even a clever move in China. The big question is whether the market is pricing in permanent failure or whether this is a genuine deep value opportunity. Let's set the stage with the company profile. Stellantis is headquartered in the Netherlands, and it's led by CEO Antonio Filosa. They employ roughly 260,000 people globally. The company operates in a highly cyclical industry, auto manufacturing, and they've got a massive global footprint selling vehicles across North America, Europe, and emerging markets. The key thing to understand about Stellantis is its scale. They generate well over $150 billion in annual revenue. That's a massive industrial base, but size hasn't protected them from the cyclical downturn. We've seen their financials take a serious hit, and that's what we're going to dig into. Looking at the revenue picture, we can see the cyclical nature of this business clearly. In 2023, Stellantis was generating close to $190 billion in revenue. That was a peak year. By 2024, revenue had slipped to about $157 billion. And in 2025, it came in around $153 billion. So we're seeing a slow bleed at the top line, which is typical for an auto company in a demand trough. But the real story isn't just the top line, it's the margins. Gross profit went from a robust $35 billion in 2023 to a negative $4 billion in 2025. That's a massive swing. When you see gross margins compress like that, it tells you they're discounting heavily to move inventory, and they're dealing with high input costs. Revenue segmentation is important here because North America is the profit engine for Stellantis, and the recent recovery in that region is what drove their return to profitability in the second quarter of 2026. Now let's talk about the earnings picture, because this is where the turnaround narrative gets interesting. The full year 2025 was a disaster. The company reported a net loss of over $22 billion, which translates to an EPS of negative $7.75. That's a huge red ink year, but we need to keep in mind that this looks like a one-off trough year. The forward estimates tell a different story. For 2026, analysts are modeling a return to profitability with net income expected to be around $2 billion. And that trajectory is expected to continue, with estimates climbing to nearly $4 billion in 2027 and over $5 billion in 2028. We actually saw this turnaround start to materialize in Q2 2026. The company swung to a profit, boosted by rising demand in North America. Management cited higher shipments, stronger production efficiency, and cost reductions. They also reaffirmed their full-year outlook and expect positive industrial free cash flow by 2027. That said, the stock still fell 5% on the earnings release. Why? Because the market is skeptical about execution, and there are still major headwinds. We'll get to those in a moment. Management commentary from the recent earnings call was focused on operational discipline. The key message was that Stellantis is on a path to sustainable growth, with a focus on improving industrial execution, enhancing profitability, and managing costs and capital efficiently. They acknowledged the pricing pressure in the market and the need to clear dealer inventory, which had climbed to around 92 days of supply in the U.S. The tone was cautiously optimistic, but they were careful not to overpromise. They know they have to prove this recovery is durable. The market is watching their execution in the second half of the year very closely, because that's what will determine whether this is a real turnaround or just a dead cat bounce. Let's get into the balance sheet and the key financial metrics, because this is where the risk shows up. The return on equity is deeply negative. around negative 34%. Return on invested capital is also negative. The free cash flow yield is deeply negative, reflecting the fact that they burned through cash in 2025. In fact, free cash flow for 2025 was negative $12.6 billion. That's a major concern. On the balance sheet, they still hold about $30 billion in cash, which gives them some runway. But the debt-to-equity ratio is sitting at around 0.85, and total liabilities are over $140 billion. The current ratio is just above 1, which means they don't have a huge liquidity cushion. The gross profit margin collapsed to less than 1% in 2025, and the net profit margin was negative 12%. These are trough-level numbers, but we should note that there was positive free cash flow history before this downturn. In 2023, they generated over $12 billion in free cash flow. So this is a business that can generate massive cash when the cycle turns. The question is just how long the trough lasts. Now let's frame this with a proper SWOT analysis. Starting with strengths. Stellantis has an incredible portfolio of iconic brands. Jeep and Ram are powerhouse franchises in North America, and they have a strong commercial vehicle business in Europe. They also have a massive global manufacturing footprint and the scale to be cost competitive when operations are running smoothly. And despite the recent losses, they still have a strong cash position of around $30 billion. On weaknesses. The company has been bleeding market share, particularly in the U.S. The dealer inventory situation has been problematic, with too many vehicles sitting on lots. Their EV transition has been rocky, and they've had to discount heavily to move product. The negative margins in 2025 show that cost discipline slipped, and there's the massive recall of 1.5 million Ram pickup trucks over a seatbelt issue. That's a quality and brand perception problem. Now the opportunities. This is where it gets interesting. They're bringing Jeep production back to China, which analysts are calling a brilliant strategic bet. China is the largest auto market in the world, and Stellantis has been largely absent there. They're also betting on smaller, more affordable vehicles, the low-speed electric vehicle segment, which could tap into a growing demand for budget-friendly cars in the U.S. And they have a $70 billion turnaround plan that could unlock significant value if executed well. And the threats. The competitive environment is brutal. Chinese EV makers are flooding global markets with cheap electric vehicles. Pricing pressure is severe across the industry. There's also the potential sale of their Brampton plant in Canada, which shows their restructuring, but it also highlights the ongoing capacity rationalization. And then there's the cyclical risk. If the global economy slows further, auto demand could weaken again. Let's look at the recent performance picture. The stock has been on a rough ride. Over the past month, it's down about 7%. Over 3 months, it's down over 35%. And over the past year, it's down roughly 45%. The 5-year return is down nearly 74%. This is a stock that has been absolutely crushed. But here's the thing about cyclical stocks. The best time to buy them is often when the sentiment is most negative. The stock is trading at around $5 and change, which is near the lows. The market is pricing in a lot of bad news already. The question is whether the turnaround plan can deliver results faster than the pessimists expect. Now let's get to the valuation, which is where things get really interesting. We plugged STLA into the MarketSnap intrinsic value calculator, and the model we used here is the EV/EBITDA approach. This is the right lens for a cyclical automaker because it smooths out the earnings volatility and focuses on the underlying cash-generating ability of the business. The model confidence is high, which gives us some comfort in the output. Here's what the model tells us. The stock is currently trading at around $6. The MarketSnap fair value estimate comes in at roughly $13. That suggests the stock is trading well below what the model thinks it's worth, maybe a gap of over 100%. Even the more conservative DCF estimate puts fair value in the neighborhood of $10 to $11, which is still well above the current price. So what drives this valuation? There are a few key assumptions at play. First, the model assumes a recovery in profitability over the next few years, with net income climbing back to around $5 billion by 2028. Second, it applies a normalized EV/EBITDA multiple of 1.5 times, which is conservative for the industry. The sector average is much higher. Third, it assumes the company can convert a meaningful portion of net income to free cash flow as the cycle recovers, with conversion ratios improving from 30% up to 45%. But here's the honest truth about these numbers. Changing assumptions can move fair value a lot. If the recovery stalls, or if pricing pressure persists, the fair value could drop to the $8 to $10 range. If the turnaround exceeds expectations, it could be worth even more. This is not a precise target. It's a ballpark based on a set of reasonable assumptions. If you disagree with our inputs, plug in your own growth or discount rate assumptions on our intrinsic value calculator at MarketSnap.com and see how the number shifts. All right, here's my take on Stellantis. This is a classic deep value, cyclical turnaround play. The stock has fallen 80% from its peak, and the market is pricing in a lot of failure. But the underlying business is starting to show signs of life. They return to profitability in Q2 2026. They're making smart strategic moves like bringing Jeep back to China. And they have a clear plan to restore margins and generate positive free cash flow by 2027. The valuation is compelling. At around $6, with a model fair value in the low teens, there's potentially 100% upside if the turnaround delivers. If you put $10,000 into STLA today, and the recovery plays out as modeled, that could grow to somewhere around $21,000 over 5 years, roughly a 16% annualized return. That's a solid outcome for a cyclical recovery. But let me be clear about the risks. This is not a low-risk investment. The execution risk is massive. Management has talked a good game before and failed to deliver. The competitive pressure from Chinese EV makers is relentless, and pricing power is weak. If the North American recovery stalls, this stock could stay depressed for years. The negative free cash flow in 2025 is a real concern, and they need to prove they can manage their cash burn. What would make me more confident? I'd want to see dealer inventories come down significantly. I'd want to see pricing stabilize in North America, and I'd want to see the free cash flow turn positive ahead of schedule. The next couple of quarters are going to be critical. For a long-term investor with a high risk tolerance, this could be a contrarian opportunity. For anyone who needs stability, this is probably not the right fit. The market is pricing in a recovery, and if it comes, the upside is significant. If it doesn't, you're looking at a value trap. What do you think about STLA? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.